There is a quiet machine moving money through the market right now, and most people do not see it because they are looking at the wrong screen. They are looking at the headline, they are looking at the index, they are looking at the same 7 or 10 famous companies that everyone else is talking about. But beneath that surface, capital is rotating. It is leaving some crowded areas and moving into places that still look boring to ordinary investors. And when that happens, the difference between being early and being late can become very large. This is how markets usually work when the easy part of a cycle is ending. The public sees one market, the professionals see flows. The public asks, what is the SP doing today? The professionals ask, where is the money going next? That difference sounds small, but it is not small. It is one of the most important differences in investing. Because an index can appear to go nowhere while individual sectors quietly move a great deal. If you do not understand that, you can spend a year watching your portfolio drift sideways while a small part of the market is compounding very aggressively. I have seen this happen many times. The machine is simple once you understand it. Money does not disappear when the market becomes difficult. It moves from crowded places to less crowded places. It moves from expensive trades to cheaper trades. It moves from yesterday's winners to tomorrow's beneficiaries. It moves towards scarcity, policy support, inflation protection, energy security, defense needs, infrastructure needs, and the kinds of real assets that suddenly matter when the macro environment changes. Right now, there are two areas where that rotation matters a great deal. One is the machinery and infrastructure layer behind oil and gas. The other is the minerals layer behind electrification, nuclear power defense, data centers, and energy independence. Those are not the sectors most retail investors open their phones to check every morning. That is exactly why they deserve attention. Most people are still living mentally in the market that existed a few years ago. In that market, nearly everything went up, and you could feel like a genius simply by owning whatever was popular. That was a different climate. Liquidity was easier, rates were lower. Speculation was rewarded. The system gave people the impression that being casual was the same as being right. But investing is not about what worked in the last climate. It is about recognizing what climate you are actually in. I think about the economy and the market the way I think about weather. You cannot control the weather. You cannot predict every storm perfectly. And if you try to build your entire life around perfect forecasts, you will make bad decisions. What you can do is look outside, observe the conditions, and dress appropriately. If the temperature changes, you change what you wear. If the market climate changes, you change what you own. That is not speculation. That is adaptation. The climate now is not the climate of 2021. Investors are dealing with inflation risk. They are dealing with the possibility that interest rates may not fall as quickly as people hope. They are dealing with governments that continue to spend and print. They are dealing with central banks trying to manage a difficult balance. They are dealing with geopolitical stress, energy risk, oil shocks, supply chain vulnerability, and a world where every country has started to care more about resilience than pure efficiency. When you put those pieces together, the implication is clear. What you own matters more. Timing still matters. But the larger issue is not whether you bought on Tuesday or Thursday. The larger issue is whether you are standing in the part of the system that benefits from the current climate, or whether you are standing in a part of the system that depended on the old climate staying in place. This is why I do not begin by asking which stock looks exciting today. That is the wrong starting point. I begin by asking what kind of world we are in. Then I ask which sectors have the strongest tailwinds in that world. Only after that do I ask which companies are leading inside those sectors. If you reverse that order, you usually end up chasing noise. Most individual investors do exactly that. They wake up, open the news, look at the SP 500, glance at a few mega-cap stocks, and ask what moved today. They are looking at what everyone else is looking at. They think they are being informed, but in many cases, they are simply participating in a crowded attention machine. The bigger money often works differently. I do not mean the money is magic. I do not mean it is always smarter. A lot of institutional money can be wrong, but it is usually trained to think in flows, relative attractiveness, risk, liquidity, and positioning. It asks where money is entering and where money is leaving. That is the game. Follow the money. If you can learn to see that, you are no longer trying to guess the next hot stock from a headline. You are watching a system. You are seeing how capital moves across the chessboard, and that matters more now because the index itself has changed. Most people think buying the SP 500 means buying 500 companies in a balanced way. That is not how it works. The SP 500 is market cap weighted. That means the largest companies receive the largest weight when more money flows into passive index funds. More money automatically flows into the biggest companies in the index. The bigger they get, the more they are bought, the more they are bought, the bigger they can become. That creates a flywheel. Flywheels are powerful when they are working in your favor. They are dangerous when people do not understand what they are exposed to. If one company is 10 times larger than another company, then each dollar of passive index buying sends much more demand into the larger company. It is automatic. It does not involve a thoughtful decision about valuation, cycle, concentration, or risk. It is simply the design of the system that is why the largest companies can keep getting larger for a long time. It is also why the system can become fragile. When a small group of companies becomes a very large share of the index begins to behave less like a broad representation of the economy and more like a concentrated portfolio of the biggest winners. That may be fine while those winners continue winning. It can even be very profitable. But if they stop leading, the passive investor can be stuck without understanding why. The market may look diversified on paper while being concentrated in reality. That is the risk most people do not see. You may think you own the market. In practice, you may own a heavy dose of the top companies plus a long tail of everything else. That is not necessarily bad. I am not saying index investing is wrong. Simple index exposure can be useful. The point is different. The point is that you should know what you own and why it is going up. If the biggest companies are rising, passive investors benefit. If those companies stop rising, the same machine that helped can stop helping. This is why some sophisticated investors use more concentrated instruments when they want exposure to that flywheel. They do not pretend they are buying the whole economy. They know they are buying the largest part of the flow. That can be rational if it fits the plan and the risk limits. But there is another side to the story. When capital begins rotating away from the crowded leaders, the opportunities are not always in the obvious places. They are often in sectors people have not studied, industries people think are boring, and companies that sit behind the activity rather than in front of it. This is where the picks and shovels idea becomes important. During a gold rush, the people digging for gold are not always the ones with the best economics. Sometimes the more reliable beneficiaries are the people selling the tools, building the infrastructure, moving the materials, and maintaining the system that allows the rush to continue. That logic applies directly to energy. Many investors know the names of big oil producers. Far fewer understand the companies that provide the drilling equipment, compressors, complex tools, field services, pipelines, LNG infrastructure, offshore systems, and maintenance that make energy production possible. Those companies can benefit when the world needs more energy infrastructure. Even if an investor does not want to make a pure bet on the price of oil, that distinction matters. The world needs energy. That is not a slogan. It is a constraint. Artificial intelligence needs a lot of energy. Data centers need electricity, cooling, backup systems, and physical infrastructure. Industry needs reliable power. Countries need energy security. When geopolitical stress rises, the desire for domestic and secure supply rises with it. When key energy routes become unstable, countries do not simply shrug. They build storage. They expand infrastructure. They consider new pipelines. They increase spending on systems that reduce their vulnerability. That is why oil and gas machinery and services deserve attention. It is not just an oil price story. It is an infrastructure story. It is a security story. It is a supply chain story. It is a capital spending story. One company in that space is Baker Hughes, ticker BKR. The reason I look at a company like Baker Hughes is not because I want to tell someone to buy a stock tip. Stock tips are dangerous when they are separated from process. The reason it matters is that it sits in the picks and shovels layer of oil and gas. It is one of the major oil field service companies. It benefits from spending on equipment, infrastructure, and energy systems. When the energy system is under pressure, the companies that help build and maintain that system can become very important. The question is not, do I like the story? The question is, do the story, the sector flow, the chart, and the risk setup line up? That is how I think. A story by itself is not enough. A chart by itself is not enough. A cheap price by itself is not enough. You want several pieces of evidence pointing in the same direction. When I look at a chart in that situation, I am not trying to buy something simply because it went down. Many people think successful investing means buying low in the simplest possible sense. That idea is incomplete. Buying low can work, but buying weakness without evidence of a turn can also trap you in dead money. What I want to see is a base. I want to see a stock move sideways after a prior move. I want to see repeated highs in a similar zone. I want to see repeated lows hold in a similar zone. I want to see the market absorb supply. Then, if price begins to break above that range with evidence of institutional demand, I become much more interested. That is why the idea of buying a little higher can be rational. Most people are emotionally trained to hate paying more. They think paying a few cents or a few percent above the current price means they are being foolish. But professionals often care more about confirmation than about getting the absolute lowest possible price. Paying slightly more after a breakout can reduce certain kinds of risk because it shows that the market is beginning to agree with the thesis. It does not eliminate risk. Nothing eliminates risk, but it changes the probability structure. That is the key idea. The same logic applies to a smaller name like NPK, a company connected to temporary worksite infrastructure for energy and construction projects. It is not the same kind of giant as Baker Hughes. It is smaller. It has already moved significantly. It has institutional ownership. It has analyst support, but none of those things are enough by themselves. The process is still the same. I look for the sector flow. I look for the base. I look for the breakout level. In the original setup, the level to watch was around 15.28. Not because a number is magic. Numbers are not magic. A level matters because other market participants can see it. If price repeatedly fails near a zone, then a move above that zone can tell you something about demand. It can tell you that sellers are being absorbed. It can tell you that buyers are becoming more aggressive. It can tell you that institutions may be stepping in. Again, this is not a command to buy. It is a framework for thinking. The mistake people make is that they want the conclusion without the process. They want the ticker without the risk plan. They want the upside without the discipline. That is how people get hurt. A stock tip without position sizing is not an investment process. It is a lottery ticket with a business name attached to it. This is why I care about the second sector as much as the first. The second sector sounds less exciting at first. Mining, quarrying, non-metallic minerals, critical minerals, rare earths, uranium, lithium. These words do not usually create the same emotional reaction as artificial intelligence or mega-cap technology, but that is exactly the point. Many of the most important opportunities sit behind the visible trend. If the world becomes more electric, it needs minerals. If electric vehicles grow, batteries need minerals. If renewable energy expands, storage systems need minerals. If grids are modernized, copper, rare earths, and other inputs become more important. If defense systems become more advanced, they need specialized materials. If AI data centers require more power and cooling, the physical supply chain behind that demand becomes more important. And if countries decide they do not want to depend on rivals for critical resources, domestic supply chains become a strategic priority. That is where the investment logic comes from. It is not a random stock story, it is a structural demand story. In the source material, one important point was that the US government had mobilized financing to develop domestic mineral supply chains. Whether one likes government involvement or not, policy demand matters, because capital follows incentives. When governments, corporations, and strategic buyers all move in the same direction, the sector can receive a powerful tailwind. That does not mean every stock in the sector goes up. It means the pond is worth fishing in. Then the job becomes finding the stronger fish. One of the companies in this area is SQM, Sociedad Química y Minera de Chile. One of the major lithium producers in the world. It has operations tied to lithium supply, and lithium connects directly to batteries and electrification. In the source setup, the company was discussed in connection with growing operations, partnership with Chile's state-owned mining company, and spending to expand capacity. The chart logic remained the same. Look for the base, look for the breakout, look for confirmation. In that example, the level discussed was around 95.50 near a prior high. The interest was not in buying simply because the company sounded attractive. The interest was in waiting for price to prove that demand was strong enough to move through a previous resistance area. That is an important distinction. A good theme can still have bad timing. A good company can still be a bad trade at the wrong price. A stock can be cheap and keep getting cheaper. A stock can be expensive and keep getting more expensive because the flow is moving into it. The market does not reward our emotional preferences. It rewards alignment with reality. Another company discussed was Uranium Energy Corp, ticker UEC. The reason uranium matters is that energy demand is rising at the same time countries are thinking more seriously about secure supply. Nuclear power is part of that conversation because it can provide large-scale baseload power. AI data centers increase the pressure because their energy needs are enormous. If domestic uranium production becomes more important, companies positioned inside that chain can become more relevant. In the source, UEC was described as having started production at a uranium mine in South Texas, with another operation in Wyoming and the capacity to process a large amount of uranium per year. The point was not that this automatically makes the stock a buy. The point was that the company belongs on the watch list because the strategic logic and the sector logic are both developing. This matters because sometimes the best action is no action. That is hard for retail investors. People think watching something means they are missing it. They think if a stock is interesting, they have to buy it today. That is not how a good process works. A watch list is not a shopping list. A watch list is a map of possibilities. You watch, you wait, you compare, you update, you let the market show you whether the thesis is becoming more or less likely with UEC. The source setup described a stock that had run hard, collapsed, and then began showing higher lows. That can be the early shape of a reversal, but early is not always better. Sometimes early simply means uncertain. In that case, the discipline is to recognize the potential without forcing the trade. That is how risk is controlled. You do not have to catch the first move. You need to catch the move where the probability and the risk are acceptable. The third name in that minerals and rare earth area was CMP. Again, the process is the same. The source setup described the stock as being near a possible breakout, with interest around the 27 area. The point was not that 27 is sacred. The point was that the market had shown an area where supply existed, and a move through that area could signal a change in demand. This is where many people misunderstand the idea of paying up. They think the goal is always to buy before anyone else sees it. In reality, that is often a dangerous fantasy. Professionals often prefer to see evidence that other buyers are arriving. They are not trying to be the lonely hero at the bottom. They are trying to participate when probabilities improve. That is why breakouts matter. That is why volume matters. That is why sideways bases matter. That is why sector leadership matters. That is why the big picture matters before the stock pick matters. The sequence is everything. If you start with the ticker, you will create a story around it. If you start with the world, the sector, and the flow, the ticker becomes the final expression of a larger idea that is a much better way to think. This is also why I do not see the stock market as one simple line going up or down. The daily financial media often talks as if the market is a single object. The market rose, the market fell. Investors were optimistic, investors were fearful. That kind of language is easy to understand, but it can hide the real action. The market is a chessboard. One square may be software, another may be oil and gas services, another may be uranium, another may be gold miners, another may be construction, another may be insurance, another may be healthcare, another may be electronic components. Capital moves between those squares. When money leaves one place, it does not necessarily leave the market. It may move somewhere else. The index can look weak while a few sectors are strong. The index can look strong while many sectors are weak. If you only watch the broad index, you can miss the rotation taking place underneath. This is especially important in sideways markets. A sideways index is not a dead market. It can be a market where leadership is changing. It can be a market where old leaders are being distributed and new leaders are being accumulated. It can be a market where impatient people see nothing and disciplined people see rotation. That is why the follow the money principle matters. You do not have to be brilliant. You do not have to predict every economic report. You do not have to know exactly what the Federal Reserve will do 6 months from now. You have to watch where capital is actually going and then manage your risk carefully. Risk management is the part people skip because it is less exciting than naming stocks. But without risk management, the whole framework becomes dangerous. The first rule is that any position must be sized so that a loss does not damage the system. In the source logic, the risk was usually structured so that a wrong trade could cost no more than about 1% of the portfolio. That does not mean the position itself is 1%. It means the difference between the entry, the stop, and the position size is arranged, so the maximum intended loss is controlled. That distinction matters. A small position can still be too risky if the downside is unmanaged. A larger position can be acceptable if the risk is clearly defined. This is why serious investing is not about being right all the time. It is about making sure that when you are wrong, the loss is survivable. And when you are right, the payoff can matter. That is the asymmetry you are looking for. Many retail investors reverse that. They take small profits quickly because they are afraid, and they take large losses slowly because they are hopeful. That is one of the most destructive patterns in markets because it is based on human nature rather than principle. A good investment process must be designed to protect you from your own impulses. That is why I prefer rules. Rules do not make the future certain. Rules make behavior more consistent. When the market is emotional, consistency becomes an edge. So the practical way to think about these sectors is not to rush out and buy every ticker mentioned. That would miss the point. The practical way is to build a process. Observe the macro weather, recognize that inflation, rates, government spending, energy security, resource scarcity, and geopolitical stress create a different environment than the easy money period. Identify the sectors receiving tailwinds from that environment. In this case, oil and gas services and critical minerals are two areas where the logic is strong. Then narrow the focus to leaders or potentially improving companies inside those areas. Then wait for price to confirm. Then size the position so that being wrong does not hurt you badly. Then monitor the flow. If the money stays, you can stay. If the money leaves, you leave with it. This is not emotional, it is mechanical. That is why it works better than guessing. It also explains why a person can do well in certain areas even when the broad market looks poor. If the SP is flat or down but money is moving into oil and gas services, construction, insurance, healthcare, electronic components, defense, mining, or other leading sectors, there may still be opportunity. The market is not one body. It is a system of internal movements. The people who understand that system stop asking the wrong question. They stop asking, is the market up today? They start asking, where is leadership emerging? That one question changes everything. It also keeps you from becoming hypnotized by mega-cap names. There is nothing wrong with owning great large companies. Some of them are extraordinary businesses. But if everyone is staring at the same names, the opportunity may no longer be in discovering them. It may be in understanding the consequence of concentration and then watching where the next rotation begins. Sometimes that rotation is obvious only after it has already happened. The goal is to see it when it is beginning, not when it is already on television. Mainstream media is usually late because media responds to what has already become visible. Markets often move before narratives become popular. By the time everyone has a clean explanation, a lot of the return may already be gone. That is why the boring work matters. The boring work is reading the weather. The boring work is ranking sectors. The boring work is watching bases. The boring work is measuring volume. The boring work is defining risk. The boring work is updating the watch list. It may take about an hour a week if you have a decent process. That sounds like work because it is work, but most people spend 40, 50, or 60 hours a week earning money and then spend almost no serious time learning how that money is allocated. That is not rational. If your savings represent years of your life, they deserve a process. You do not need to become obsessed. You do not need to stare at screens all day. You do need to understand that money management is a skill, and skills require practice. The deeper lesson here is not that one stock is good or bad. The deeper lesson is that markets are systems of cause and effect. When liquidity changes, behavior changes. When rates change, valuations change. When inflation persists, scarcity matters more. When geopolitics become unstable, security matters more. When energy demand rises, infrastructure matters more. When electrification expands, minerals matter more. When passive investing concentrates flows into mega caps, the index becomes more concentrated. When that concentration stops working, capital looks for the next place to go. Those are cause and effect chains. The investor's job is not to be emotional about them. The investor's job is to observe them, understand them, and respond with discipline. That is what following the money really means. It does not mean blindly chasing what went up yesterday. It means recognizing the path of capital through the system. It means seeing that a sector can become attractive before the average person understands why. It means accepting that the best opportunities are often uncomfortable because they appear in places that do not yet have popular stories. It means buying only when the setup is strong enough and the risk is defined. It means not confusing excitement with evidence. It means not confusing a narrative with a process. So when I look at the market now, I see a broad index that can mislead people because of concentration. I see a public still focused on the same crowded mega-cap leaders. I see macro weather that is very different from the easy money period. I see energy, infrastructure, minerals, nuclear inputs, and strategic supply chains becoming more important. And I see the need to look beneath the index to understand where capital is rotating. That is the real message. The next big opportunity may not look like the last one. It may not be in the stock everyone talks about at dinner. It may not be in the company that already became a household name. It may be in the machinery behind energy production. It may be in the infrastructure behind natural gas. It may be in the minerals behind batteries. It may be in uranium behind nuclear power. It may be in the quiet companies that make the visible future physically possible. That is why you have to think in systems. Every visible trend has an invisible supply chain. Every new technology has an energy requirement. Every energy requirement has an infrastructure requirement. Every infrastructure requirement creates demand for equipment, materials, services, and capital. The person who only sees the headline arrives late. The person who studies the chain has a chance to arrive earlier. This does not mean certainty. Markets are probabilistic. Good ideas fail, strong setups can break down, a breakout can reverse, a sector can lose leadership, a government policy can disappoint, a commodity price can move against you, a company can execute poorly. That is why humility is essential, but humility does not mean doing nothing. Humility means recognizing that you might be wrong and building the system so that being wrong does not destroy you. That is the difference between a principle-based investor and a gambler. A gambler wants the outcome, a principle-based investor wants the process. The outcome follows from the process over time. If the money rotates into oil and gas services, I want to know which companies are benefiting, where the bases are, where the breakout levels are, and how much risk I am taking. If the money rotates into critical minerals, I want to know which companies are exposed, which ones are already moving, which ones are still early, and which ones are not yet ready. If the index stays concentrated, I want to understand that my passive exposure is more concentrated than it looks. If the mega caps continue leading, I want to know that the flywheel still works. If they stop leading, I want to be able to recognize where leadership is going instead. That is not complicated in theory. It is difficult in practice. Because human beings prefer simple stories. They prefer someone to say, buy this. They prefer a ticker. They prefer certainty. They prefer entertainment. But markets do not reward the desire for simplicity. They reward clear thinking under uncertainty. The clear thought here is that money is always moving. Your job is to see it. Your job is to avoid being trapped in yesterday's crowded trade, just because it worked before. Your job is to understand that the index is not neutral when it is heavily concentrated. Your job is to know that sectors can lead even when the broad market looks dull. Your job is to watch energy infrastructure and critical minerals because the macroclimate gives them a reason to matter. Your job is to avoid reckless concentration, define your risk, and scale only when the evidence justifies it. That is a different mindset from chasing. It is slower, it is calmer, it is more rational. And in a market where the easy money has already been made, that is exactly the mindset you need. The investors who get hurt are usually not hurt because they lacked opinions. They are hurt because they had too many opinions and too few principles. They had stories but no risk controls. They had confidence but no framework. They had excitement but no patience. They had predictions but no ability to adapt. If there's one thing I would want you to take away, it is this. Do not look at the market as a single scoreboard. Look at it as a living system. Capital flows through that system the way water flows through terrain. It seeks the areas with the strongest slope, the greatest pressure, the best incentives, and the least resistance. Your job is not to shout at the water. Your job is to study the terrain right now. The terrain is changing. The old winners may still win, but they no longer explain the whole opportunity set. Energy infrastructure is becoming important because the world needs more power and more security. Oil and gas machinery can benefit because the system needs the equipment that makes supply possible. Critical minerals are becoming important because electrification, batteries, grids, defense, AI, and domestic supply chains all need real materials. Uranium matters because nuclear power has re-entered the conversation around baseload electricity and data center demand. These are not isolated stock stories. They are connected pieces of a larger system. And when you see the system, you stop being dependent on noise. You do not need to guess every headline. You do not need to chase every rumor. You do not need to buy because someone sounded confident. You watch the flows. You rank the sectors. You identify the leaders. You wait for confirmation. You size the risk. You follow the money. That is the quiet machine. Most people do not understand it. But once you see it, you cannot unsee it. And in the kind of market we are entering, that difference can be the difference between watching the index do very little and owning the parts of the market where capital is actually going.